Hi, I'm Mark Honeybone from Property Ventures, and welcome to our weekly podcast where we interview prominent members of the investment community along with other professionals in the New Zealand property market. This is a free service from Property Ventures so that you can keep current and learn from some of the best around New Zealand. To check us out, take a look at propertyventures.co.nz. We hope you enjoyed today's podcast. Hi and welcome back. So the last week the big topic has been the new LVR rules from the Reserve Bank, and we've all been sitting around the smoko rooms around the country listening and discussing what that means to us all. I know in our investor networks we certainly have been. So I thought it'd be timely to get Chris Peterson from Chris Peterson Mortgages, the expert in the property field, and talk to him and see what he thinks about it all. And together we'll just discuss what our impressions are, what that will mean for the investor and the home buyer. So we hope you enjoy the next half hour. So welcome back to the show there, Chris.
Thank you, Mark.
Okay, well let's start off by actually summarising what the rules actually were that come out from the Reserve Bank last Tuesday, and probably if you can include the exemptions in that, such as new builds, etc.
So what got announced last Tuesday was that the Reserve Bank has implemented a 40% deposit requirement for investment purchases. This kind of came a little bit out of nowhere and has probably surprised a lot of people and caused a few issues already, so there's quite a bit of confusion around this. We're still seeking some more clarity, but what was a bit unusual is roughly a couple of, probably about 3 weeks ago now, the Deputy Reserve Bank Governor was doing a talk, and actually at that stage there, made it sound like there were no more restrictions coming until late this year, and so we definitely thought we had a few more months, and suddenly out of nowhere we have this announcement last Tuesday. Generally what happens is when you've had a restriction like this come in previously, the banks I think have had maybe a little bit of advance warning about it, so very quickly afterwards we tend to get some communication coming out. But this was very different, where we were trying to call various bankers across the day, and no one really had a clue what was going on. So I think that this was pretty much brought in with a bit of a shotgun approach without too much communication. So we're still trying to get some clarity. We're finding, because of the confusion, we're quite often getting different responses out of different bankers, in some cases even within the same bank. But effectively, I suppose looking at it, is obviously last year we had the 30% restriction put on Auckland. What we saw at that stage there was a lot of Auckland-based investment money start to go around the country. Places like Tauranga, Hamilton really took off. We've seen Wellington kind of going lately. And I think with the concerns around the how hot the Auckland market has been and some of how the rest of the country has been going, they've decided to obviously increase that deposit requirement to 40%, but put it around the whole country. Now, it'll be interesting to see how this plays out. The Reserve Bank's definitely shown a willingness just to keep increasing the restrictions. So if the market does basically pick up again, I expect to see further restrictions. The likely next one, though, could be around debt to income, which I think could have potentially a even bigger effect than this one. And I wouldn't be surprised, especially leading into an election year, if it's brought in, if that's maybe targeted more adjusted investors, potentially not as much on first home buyers. They targeted investors. That obviously might make it easier for first home buyers who are finding it very difficult at the moment, which would also be politically seen to be a good option. So where it will be interesting though is new builds are still exempt. So going back to the first LVR restriction, when that was implemented, they took a couple of months to realise putting these restrictions in, well, we've got a potential supply problem in Auckland wasn't the greatest idea, so they exempted new builds. They continue to be exempt, so we expect builds to maybe become more popular as people can still kind of get them with 20% deposits. So if equity is an issue holding your back, you might want to look at new builds. Keep in mind,
We'll talk actually a bit more about new builds in a minute, I think, because it's quite a different process and depending on where the build is and stuff of where it is. So yeah, so what are any other exemptions apart from the new build is the main one, wasn't it? That we still do for 20% as an investor.
Yeah, non-banks don't have to basically abide by the Reserve Bank rules. So at the moment, I wouldn't say New Zealand's got a very strong non-bank. I suppose we don't have a very strong prime rate non-bank setup. We've got a couple of funders who are there. They are probably going to become a lot more popular because of this, because they can still theoretically work off, say, 20% deposits for investment. So you've got lenders, Resimac and Liberty, who will become a lot more popular, while they can work, expect them to be very difficult to deal with over the next couple of months, as they've got very low staff levels.
And their phones are going to be really
I'll be surprised if they don't have 1,000 applications on their desk already. They're going to be very hard to deal with. One of them's already come out, Liberty, and probably quite bright politically, is not doing pre-approvals, which means Resimac's just going to get utterly swamped, and they'll be very, very hard to deal with.
Oh, so Liberty will just be as per.
You've got to have signed contracts up.
That's going to be tough because they're going to need quite a bit of due diligence, I guess, for that to happen because of the low staff members they have in process.
Completely. I would be, at the moment, we are really telling clients I'd be probably holding off for a month or two before looking at using them, because I think they will be exceptionally hard to deal with. For the next period, when we're expecting, when we do start using them, to maybe need 15 days due diligence to use them.
Okay, someone's going to ask 15 days. So you get 3 weeks due diligence
just
for the finance clause only.
They have panel valuers and a relatively restricted list, and so the problem is probably going to become is that those valuers are going to get really under the pump as well. It doesn't matter what LVR you're going through them, they always require a valuation, unlike the rest of the banks, or in most cases don't. So these it's not just going to be a case of getting through them, you've got to get a valuation within the due diligence period as well.
That's been a bit of the problem anyway in the past, is if someone's needed a valuation, they weren't pre-approved. The valuers have been, for the last year and a half, have been so busy.
Yep.
And that's needing extensions up for due diligence. So probably one tip is, if you're doing a sale and purchase agreement, you haven't got finance, ask for as long as you can for the finance clause only.
Yeah, and definitely I think if you're going to be using these non-banks, you want to be getting and getting one of these valuers moving as soon as possible.
Great stuff. Okay, so the one thing's happened different this time from approximately May, was it last year, when they announced the 30% rule in Auckland, was they gave that 5-month lead-in period, which caused chaos, obviously, with the market, and made it probably a hotter market than it should have been throughout last year. So, as I said, unless you've got a pre-approval, basically all the banks have now brought in the 40% rule anywhere around the country.
Yeah, so that was definitely a bit of a surprise, as Mark just mentioned. The Reserve Bank announced the 30% restriction last year in May, but it was supposed to be coming in on 1 October, and so the market just went utterly ballistic for that period of time. This time, they basically announced it, and the banks immediately have implemented it. So if you don't have a pre-approval in place, you're not going to be able to kind of get anything except for a 60% lend on investments. Now, if you do have a pre-approval, and if you're wanting to, I suppose, get into the market, and if equity is going to hold you back, or these new restrictions are going to hold you back, you definitely want to be getting out there looking for a property now, because you will not get your pre-approval renewed under the existing terms.
Yeah, I just talked to someone else had earlier today, and they were saying they had some clients with pre-approvals, and over the last 6 months they've been extending. Yeah. Obviously, there will be no more extensions, so get in there. And it's been interesting enough, just in our business on the sales side, we've had a lot of people coming to us wanting to list their properties immediately to try to pick up those pre-approval buyers. So I do see the next 6 weeks being a bit of a, I won't say spike, but there'll be a lot of sales in the next 6 weeks for that reason. So, there's your one chance now to get 20% or 80% lending if you've got a pre-approval for the next, who knows how long.
Completely.
6 months, 6 years, or whatever it might be.
It's definitely just understand, if you're in that boat, you want to get out there now and go shopping.
Yeah, absolutely. So if you're listening to this and you do have a place to sell, do my wee sales pitch here, right now, or you are one of those pre-approvals, hey, give us a buzz, because we may be able to stitch a deal up for you. So talking back to the new buyer market, off the plans market, it was a good learning experience for myself last week, and I posed a question to a bank, and you're going to verify this further. Pretty well, a lot of you out there will probably be like me last week, thinking if you're buying off the plans, you'll get your 80% regardless. But it depends where you are through that process, whether it is off the plans, they haven't started building anything yet, or if it's a wee way through the project, or when it's finished and it's still a new build, but you'll won't be getting your 80%, and I believe it's something about a 30%.
Yeah.
Do you want to expand a bit more on
So
that?
basically, if the build is over 30% through, if it's before 30% through, then they can still classify it as a new build, so you can get the exemption. If it's over 30% through, they won't. So you're going to have to be effectively putting a 40% deposit in. So the new build part is interesting. Keep in mind that while the Reserve Bank has kept it exempt, we've got some lenders doing their own thing. ANZ, obviously, as the country's largest bank, has taken an unusual in some ways but interesting policy in that they will not do investment builds at all. They also aren't allowing investors effectively to buy off the plans. So while the Reserve Bank is completely fine with that and has its exemption, ANZ's obviously kind of brought their own policy in. We've had SBS, who's obviously not a big lender, but we still use them a bit, and they have aligned their investor builds along with their standard investment property, so they're only doing 60% to investor builds. So just keep. We've had the majority of the other lenders come out and say that they're just abiding by the exemptions and still going up to 80%, but it's just worth keeping a bit of an eye on that space.
It's been interesting, this property cycle compared with previous ones, where the banks have been way more stringent, I guess, rather than give the 115% loans you could get 10 years ago. But it's they've almost gone the other way. ANZ to do that. We saw come out in the press last week what the banks made in the last 12 months. They've made a few dollars. You think they might be a little bit more helpful, but as I said, every bank can still make their own policy.
Yeah, it'll be interesting, as Mark just said, that I suppose you compare to last cycle where we had very lax credit policies. We actually used to have a whole lot of non-bank options and all kind of creative products. I remember doing kind of first and second mortgage combinations up to 112% and doing no-doc mortgages and all these types of things. We were in a very different environment with a lot of credit controls being implemented.
Which is good on the whole, most of it. So be aware for the new buyer or new home purchase that you are looking at doing. So maybe get some advice from your broker or someone first, just before you racing off and are going to look at a place that's nearly finished. For example, one client the other day, he was looking. He thought he'd get at under the 80% rules for a new build. It's still not quite finished yet, but it's well and truly over the 30%. So most banks are saying no. One of the things we saw last week, Chris, was a few people on how it actually works. They had this 5% margin of exemption of maybe approving some loans below the 40 and the 20% they were talking about. Do you want to expand on that?
Yeah, we're still waiting, I suppose, for more clarity on that. I don't expect that to be allowed for, a standard investor to be able to kind of get through that. I think that's more going to be used in situations of, let's say, you've got a leaky building that needs to be sorted, P-house that needs to be fixed, potentially a marital split. I think it's going to be more used for those type of exemptions rather than, you being the lucky client who can go out there and still get an 80% lend. Also, I think the banks are they tend to find that part quite hard to monitor. Look at the initial LVR restriction, which was the 10% they were allowed to lend on loans greater than 80% LVR. They've always found that quite hard to monitor and have not tended to be anywhere actually near the 10% threshold. So with us being 5%, I think it's just going to be kept pretty unique situations.
Right. Okay. Just a few extra points, and it's just really my opinion and your opinion when you chip in for it also. So it's not what we are picking, but just comments I see might happen is I potentially see for the investor world it might hurt the smaller regions. We're going to say the smaller regions, the outside of Auckland, a little bit. And my justification beside that is obviously from 1 October last year, when the LVR made it harder for investors to buy in Auckland, they all went around the rest of the country. In a way, the Aucklanders to the rest of the country for investing has been like the Chinese has been to Auckland, but keeping the market very, very strong. And that's just a broad statement, obviously, but I do see that as a potentially happening. In saying that, the first home buyer market, what I see in Auckland and the rest of the country is still very, very strong now. There's still a shortage of quality homes, and that market I see is going to stay pretty strong, which is going to be good for the overall market, I guess, around the country.
Yeah, it's going to be an interesting next little while. I still can't figure out exactly what's going to happen. Part of me thinks that we've obviously had a lot of Auckland money leaving Auckland to go around the regions, and so with this restriction coming in, I'm thinking, and it levelling the playing field as such, I kind of expect maybe more to stay in Auckland. On the flip side of that, with it being such a large deposit requirement and obviously how high Auckland house prices are, that might mean there's quite a few investors who now can't do Auckland, who maybe have to go to the regions. It'll take, I think, a little while for all this kind of stuff to flush out.
Yeah, no, absolutely. Will be after the initial 6 weeks or 4 weeks, whatever it is, with pre-approvals being happening. It'll be an interesting 3 months after that, that's for sure.
Yeah.
Well, obviously, new builds, as you said, there's a new meaning to that now when you still get your 80% lending. We're already working with some people who are going to offer properties or even sections where they can build 1 or 2 new builds on it. This is in Christchurch, which is a perfect market. You go back to normal fundamentals of property investing, I guess. You buy in a place that's not a hot market. At the moment, Christchurch isn't a hot market. Probably potentially a prime time to buy somewhere like that. But if you can do that, buy 2 incomes about to come onto a property that hasn't been started yet, you should be able to get the 80% income there, 80% lending, and you should get some reasonable yield. So we'll see what we can do with that. It's not beating the system, it's just working with the system and staying ahead of the game, I guess. So that'll be interesting. The other thing might be interesting is people who've had, if you buy on one title 3 or 4 incomes, it might be a block of flat, it might be a boarding house or whatever it might be. The hardest thing in the past to buy one of them has been you've got to have 60% or 40% deposit, which you still have to have, but you have to have 40% deposit to buy a standalone house next door now. So they might be a good proposition for the next few years, and they may even go up in value for that exact reason. If you're sitting buying $1 million property next door that's getting 4 rents compared with one next door, that might now be a viable option where it wasn't quite so for a lot of investors recently.
Yeah, I'd completely agree with that. I think we've tended to see different investment classes historically, which may have required large deposits, have often tended to maybe in some ways look a lot undervalued. They often you'll tend to get better returns in some ways, because a lot of people, I think it's supply and demand, a lot of people haven't been able to get into them because of the deposit requirement, or they've tended to prefer go to other assets where they can put in less capital. So definitely I think things like multiple units or one title, potentially even some apartment classes which have required larger deposits and stuff like that, there may start to be more demand for them as well. Yeah,
true. The smaller departments under 40, 50 square metres, depending on what bank it is, have their own rules. That's again brings them back into play, I guess, so on an equal playing level. So it's going to be an interesting few months that come up. So what anything else happening in the banking world or the finance world, Chris, that's going on at the moment that listeners may be interested in?
It's definitely there's a lot of stuff going on that's probably not hit in the media. The banks themselves, I think, are starting to try and self-regulate. So I wouldn't say this is official feedback, but we're getting the feeling that the banks are trying to tighten up and look, shall we say, like they're being good, prudent lenders to try and, shall we say, hint to the Reserve Bank that they shouldn't regulate them more. But we're starting to see some things like occasion interest-only requests aren't necessarily always being approved. We're starting to see some of the banks sit there and decline that. In some cases, revolving credit facilities, we quite like getting large revolving credit facilities for clients. Some of the banks have tightened up on the ability to do that. On the servicing requirements, some of the banks have started to, I think, tighten some of their servicing requirements, and I think that's, again, designed to show the Reserve Bank that, look at us, we're being prudent. You don't need to implement things like the debt-to-income rules, which are potentially being spoken about. So just be aware behind the scenes that there is this tightening going on. Also, what was announced but didn't really get much media attention last November was the banks were required to hold more capital on investment loans. Effectively, what that does is make it more expensive for the banks to lend on investment property than it does on own occupied property. Now, pretty much from then through to May, give or take, the banks had tended to absorb that. I think, obviously, it's a pretty competitive market out there. We saw Westpac first initially come out. They didn't kind of go out publicly, but I think they went out to brokers and internally and announced that they were starting to price different. And a couple of the other banks have started to do that as well. So keep in mind, depending on the bank you're with, if you're with one of the lenders who maybe hasn't introduced it yet, in some cases what we're doing with clients is potentially even breaking and refixing, because they'll only put this margin on once you come off your fixed rate. So we still don't quite have a handle on how much this is costing, but if we look at Australia, where this has already been implemented, if you look on some of the websites over there, they very clearly state the owner-occupied pricing and investment pricing on their websites. In a lot of cases, there's about a 0.4% difference.
Okay, yeah, very interesting. Just on the interest only, there is still a major percentage of investors have interest only as their way of funding what they're doing, paying their property?
Yeah, it's a real mix. Obviously, people kind of tend to go interest only from a cash flow point of view, or from a tax position if they've still got personal debt. But we've definitely seen a move by a lot of investors, I suppose, from a prudency point of view, with interest rates being low. So, there's quite a few who are using it as a chance to potentially kind of put it on P&I and start paying some principal.
It's certainly the time to do that when the interest is low, isn't it? And I guess if that happens, the worst happens and interest rates go up 2 or 3%, you can actually change to interest only, and you've already got that payment history of paying, been able to survive on that, I guess. And
100% agree. And I think exactly what Mark just said there. I think maybe this is the Reserve Bank putting some pressure on some of the banks behind the scenes and kind of going, we've got maybe some people who this might be their first property cycle who haven't seen interest rates and how high they can potentially go, as we're maybe putting them on P&I now. If we see an interest rate with a 6 or 7 in it in the future, at least they can revert maybe to interest only at that stage and still stay solvent.
Yeah, it's just a way of investing. If at the end of the day, you're trying to make money from property if you're investing in it. So you're getting capital gains, and if you go through a flat period, and you can actually still pay the money with the principal, or you're still making money and getting more equity in a safer environment for your portfolio anyway.
Completely.
So obviously the 40% rule is going to halt some investors. Some will be fine. In fact, a lot will be fine. But what about those ones who they can't get that 40%? Is there any way they could work around that? Or have you seen anything already in the last week that may be another way to get into property?
So we've obviously got the non-bank options that I mentioned earlier, but besides that, something I expect to probably see a lot more of is maybe joint venture situations where we get a couple of investors potentially looking to maybe team up and pull their capital so they actually kind of can get into the market. So my first meeting I actually had this morning was a classic case that a couple of Wellington friends who, by combining their resources and the deposit fund and stuff like that, they can do a lot more than potentially what they could do by themselves.
Right. Yeah, that makes sense. I suppose it's no different than doing a project or a subdivision or whatever with a joint venture partner. The same thing. You grab someone because they have different resources, whether experience or money or pooling their funds. So I suppose there's no different with that. With buying investment, you're starting a portfolio with someone obviously you trust and know and go through the usual regime you would to check things out and do it properly.
Yeah, exactly. Something which is probably worth noting there, where it has got a bit tougher though from a funding point of view, is not all the banks, but what a lot of the lenders have started doing roughly over the last 12 months or so, since something called the Responsible Lending Code come in, is that if it's not a spousal situation, say husband and wife, if it's, for example, two friends, two siblings actually doing a joint venture, is where the banks have toughened up is rather than looking at the whole position in regards to throwing income, equity, everything into the pot. From a servicing point of view, most of the lenders assess each person individually, and they have to be able to stack up, be able to fund the whole project by themselves. So theoretically, let's say you had two people, they're both bringing capital to the table, but one of them doesn't earn much. The deals with a lot of the lenders is likely to get declined based on that person not being able to meet the whole servicing criteria by themselves. Now, this isn't all banks, so do keep in mind that you've still got a couple of lenders out there who are happy to pool all resources, so it's important to go to the right bank.
Yeah, in fact, we had a case of that last year. We had a place late last year in Manurewa, and 5 people wanted to buy the property. I think he might have been actually the person helping me through it. But of course, if one of those 5 don't come to the party or have a bad credit rating or whatever, it really kills the deal. So again, if you don't know them personally, you certainly want to check and do your credit checks with them, because that will affect your situation for that particular purchase, I guess.
And for obvious reasons, this is where you need someone who's good to advise on the structuring side of things.
Yeah, definitely. So we play for mortgage brokers, I guess, right now with every bank doing different things to save the headache of going around all these banks and get told no and no and no, and or get told no from the first bank, and you might be another bank that will do it. Obviously, is the ideal time to use a broker. Why brokers are out there helping investors and home buyers out. That's probably all we've got for this week. We just wanted to do a summary and say where things are. Have you got anything else to add, Chris, before we finish up today?
I think that's pretty much all for the moment, Mark. Thank you.
No, pleasure having you on board again, and we'll get you back when there's another potential crisis coming on the horizon.
Thanks, Mark.
So I'd like to thank Chris for coming on the show and talking about the new announcement of the 40% LVR rules last week, and to share his expertise on it. So just a reminder, if you do have a pre-approval and you need to buy something now, we have just got an abundance of properties coming to us in Wellington, Christchurch and Auckland. So give us a call at the office, or go to the propertyventures.co.nz website and contact us. Until next time, have a fantastic week.